Welcome back to our financial reporting process. In this lecture video, we are going to discuss the documentation and the generation of financial statements within the accounting information systems. First, let's start off with our chart of accounts, which is a classification scheme to organize financial data and summarize financial measurements of assets, liabilities, and owner's equity, or ALO, and our balance sheet equation, and also our accounting equation. So a chart of accounts is a coding system that logically records, classifies, stores, and extracts financial data using coding techniques, which is usually made up of numbers and letters. So a chart of accounts in a traditional system often uses block coding, with blocks of sequential numbers reserved for specific types of accounts. Here we see an example of Julia's cookies and a chart of account. And you see here we have unique blocks for a single account, and then we have blocks of number for specific accounts. Typically the hundreds are assets, 200s could be liabilities, 300s could be owner's equity. And in this case, we see that our hundreds are current assets, 200s is investments, 300s is long-term assets, and then we go into current liabilities and the rest. So from the business events that occur to when the accounting transaction is posted in the general ledger, there's usually 3 steps that we do during this reporting period. So these steps take place throughout the reporting period. Step 1, we want to identify the accounting transaction. Then in step 2, we want to journalize the accounting transaction and finally post that journal to the general ledger in step 3. Then the next 4 steps usually occur at the end of the reporting period, which could be a month, a quarter, or the fiscal year. So step 4, we're looking to prepare our unadjusted trial balance. Then we look to enter our adjusting entries into the general ledger and post them. Then since we've done our adjusting journal entries, then we are going to prepare an adjusted trial balance. And from that adjusted trial balance, we are going to prepare our financial statements. Then the final 2 steps occur at the end of the fiscal year only. That's when we prepare the closing journal entries and post them, and then we prepare our post-closing trial balance. So all of these steps is the accounting cycle and how we go from business transactions to financial statements to a post-closing trial balance. And here you see our financial reporting process, our flow chart, where we do during the reporting period, at the end, and then at the end of the fiscal year, and all of the steps associated with that. So here we see an accounts receivable subsidiary. So we are looking at Julia's Cookie, and we are looking at the account for Good Foods, Inc. And basically we see their beginning balance and the sales that we made. So we would debit accounts receivable and then the amount that they paid us from a cash receipts perspective. And here we have an example of an unadjusted trial balance. Keep in mind that our debits equal our credits in all trial balances if we did everything right. Then we have financial reporting internal controls. So since modern accounting systems are very data-centric, it follows that technology risks are just as important to address as well as those traditional accounting risks. So to address the management, implements internal controls over financial reporting, which are control activities specifically related to the financial reporting process. And so here we're looking at accounting policies and procedures, the risks and control activities. So our risk statement here is that we're going to fail to adhere to the proper financial reporting regulations and standards, such as US GAAP, and that could result in fines or fraud or misstatements within the financials. Then we see that the owner of these control activities is the controller. So they might actually make a current version of the policies and procedures available to the users, or ensure that our policies are actually in adherence with GAAP and properly documented, implement any changes, and make sure that those policies and procedures are followed with hopefully no exceptions. Additionally, we might want to discuss broad financial reporting risks and controls. And here you see that the controller does have a responsibility over using a reporting schedule for our monthly, quarterly, and annual reporting periods. In addition, he or she may include the schedule, and we might have cutoff dates that are actually consistently applied across the company. We might also have the automated control system and the controller look at journal entries that are posted to the GL for accuracy and making sure that those journal entries are posted in the correct reporting period. Additionally, we might have that these control activities apply to a multitude of risks throughout our broad financial reporting processes. So here we see that the controller is also involved in all of these control activities, such as reviewing and resolving our error reports, or making sure that there aren't any irregular or manual journal entries at a high level. Then they has to be reviewed and approved to make sure we have all the appropriate documentation. Also, the controller might review the monthly accruals to make sure that all of the liabilities and prepayments are adjusted, or look at the contingent liabilities and make sure that we are making those accruals as is required by GAAP. We might also have the controller looking at ensuring that the segregation of duties are and for incompatible responsibilities in both corporate accounting and financial reporting. And this lends itself to the risk statement that these control activities apply to a multitude of risks, right, throughout the entire financial reporting process. We might also have the controller reconcile our general ledger accounts each month and automate where possible. Like if we can automate bank reconciliations, that's fabulous, because who likes to do bank recs? Then we might have the controller or the treasurer, in this case, review the reconciliations and see if there's any discrepancies. Additionally, a risk statement that we might look at as it relates to specific financial reporting risks and controls, right? The financial statements do not comply with GAAP or have inconsistencies, or worst yet, violate some SEC requirements that can result in fines or penalties or even litigation. So in this case, the CEO or the CFO want to ensure that legal compliance with all the statutory requirements, including taxes. And then we might also have the head of legal or compliance perform reviews of those financial reporting standards. Additionally, we might have the risk of reporting complexities may result in the financial statements or other reports that are inaccurate or not reliable, or that they're not even issued in a timely manner. So here the controller would determine some general ledger account responsibilities. Additionally, we might have, again, that these reporting complexities could result in our financials not being either completed on time or inaccurate or unreliable. And then here, the controller would ensure accountability by assigning general ledger accounts to owners or someone who is responsible for overseeing that activity. Then we might have the risk of having a loss of assets that could be to fraud, theft, negligence, or destruction, and this may result in a lack of proper reflection in the financial statements. So in this case, the CFO and or controller would review asset accounts at regular intervals to check those balances, making sure maybe not to exceed our lower of cost or market, for inventory, and make any authorized adjustments. Again, dealing with the loss of assets, right? Whether it's for fraud or theft or negligence, we might also have the CFO or controller document evidence that this review was actually performed. We might also have another risk of incorrect or fictitious or omitted or duplicate any recorded journal entries, and that could also misstate our financial statements. So here it could be the controller or even our IT controls or an automated system that can grant the journal entry system permission only to whatever authorized individuals or require approvals and independent checks. Another risk that we might have when we're discussing specific financial reporting risks and control activities is we might have some unauthorized access to documents or records, and or these records could be destroyed, they could be altered or lost. So in this case, the controller or an automated system or IT general controls could hopefully ensure that only authorized individuals have access to the accounting information system or databases or records and documents, and that only these authorized individuals discuss financial information with third parties. Additionally, we might run the risk that our complex and non-routine accounting transactions, we might record them incorrectly. So in this case, the CFO or even maybe the HR director, they might hire and retain knowledgeable accounting staff and provide continuing professional education to make sure that the accounting staff is up to date on all of the FASB reporting requirements. We might also run the risk of, again, improper authorization of entries and transactions that could result in errors or fraud. So here again, the controller might grant journal entry systems permission, again, only to authorized individuals, and that would require approvals and possibly periodic independent checks. Then we might also have unauthorized access to proprietary or confidential information, and that could result in some reputational damage or loss of competitive advantage. In this case, the CFO or the controller would want to ensure that, again, only authorized individuals have access to all of this systems, the AIS or the databases. We might run the risk of unauthorized access, right, to, again, our proprietary and confidential information. And in this case, the CFO and controller would just make sure that only authorized individuals are discussing this information with third parties. Additionally, we might run the risk of related party transactions that could be improperly identified or incorrectly recorded. And in this case, the CFO or controller would want to identify related parties and report those transactions, especially intercompany transactions for consolidation purposes, making sure that we report this according to GAAP. So I hope you've learned quite a bit in this lecture about broad and specific financial reporting risks and control activities. Thank you for watching.